Hi everyone, welcome to your Money Q&A question of the day. I'm your host, Stacy Johnson. This answer is brought to you by MoneyTalksNews.com, serving up the best in personal finance news and advice since 1991. Today's question comes to us from Cindy, and here's what she says. Cindy says, I hear that when interest rates go up, bond prices go down. However, I truly don't understand when the best time to buy into bonds would be. For instance, if interest rates go up, are bonds cheaper to buy? I also don't understand how to buy bonds or what type of bonds would be the right purchase for various situations. Well, you're making bonds sound really complicated, Cindy, and they're kind of simple. Let's go over a couple of basics. Bonds, of course, are a loaner investment. Stock is an owner investment. When you own stocks, you own a part of a company. When you own bonds, you've lent money to a company. Just like when you get a CD at the bank. You're lending them your money, they're agreeing to pay you back at a certain time and pay you a certain interest rate for using your money. That's what a bond is. It's a loaner investment. There are two reasons you buy bonds. One is because bonds pay interest. You might need the income, so people who need income often buy bonds. The other is because you don't want to have all your money in stocks. Bonds are typically safer than stocks. So it's one of two things. Either you need income or you want to keep your money a little safer than it would be in the stock market. These are the people who buy bonds. Now, as far as bond pricing goes, here's what I want you to do. I want you to picture a seesaw or a teeter-totter, whatever you want to call them. They don't have those anymore in parks, I found out recently, but when I was a kid, they did. Okay, so market interest rates. When market interest rates are going up, bond prices on this side of the seesaw are going down. When interest rates are dropping, bond prices are rising. So when interest rates are high, bond prices are low. When interest rates are low, bond prices are high. They move the opposite of interest rates. So right now, as I speak, interest rates have been rising. That is going to affect the price of bonds in a negative way, right? So when interest rates are going up, bond prices are going down. The longer the term the bond, remember I said a bond was kind of like a CD. It could be coming due in 6 months. It could be coming due in 30 years. The longer it is until that bond comes due, the more it's affected by market interest rates. So if you've got a 30-year bond and interest rates are rising, that bond could go down in value way more than a bond that's shorter term. That makes sense. How much can a bond go down short term if it's about to come due? Because when it comes due, you're going to get back the money you put into it. Another thing that affects the price of bonds is the quality of them. They can be AAA rated, which is the highest rating. They can be government bonds, which is even better because the government prints money. It literally can't default. So a government bond is the safest thing you could possibly buy. It could be a junk bond, a company that may have trouble paying you back when that bond matures. So the quality of the bond also matters. And then finally, you can get both. You can get bonds by buying them individually, or you can buy them in a mutual fund. What's a mutual fund? It's just a bunch of people getting together, pooling their money, hiring an expert to buy bonds for them. And so you're owning a slice of a whole bunch of bonds instead of one or two. Bonds come in increments of $1,000 if they're corporate bonds, and they come in $5,000 increments if they could be municipal bonds and come in $5,000 increments. Municipal bonds are tax-free also. There's a lot of stuff to know here about bonds, isn't there? But the main thing to know is that what Cindy asked about originally was she doesn't understand what influences the price of bonds. When do you want to buy them? You want to buy bonds when interest rates are high. I remember when I first became an investment broker for E.F. Hutton back in 1981, you could buy a AAA rated tax-free bond that paid 13% interest. Now, wouldn't you want to do that today? You're locking in that price when those interest rates are high. So you're locking in a 13% tax-free rate when interest rates are high like that. Now, do you want to buy a tax-free bond today when interest rates are 2? No, you want to wait. So the best time to buy a bond is to buy when interest rates are high. Lock in that interest, and then that bond will become more valuable as interest rates drop. Does that make sense? Now, suppose you want to buy bonds anyway, even though you know interest rates are gonna go up or they're low. That's okay. Buy short-term bonds, buy a short-term bond fund, and then it won't do that well if interest rates are rising, but at least when interest rates are rising, those bonds are coming due, and you're getting higher and higher interest as interest rates go up in the market. I hope that makes sense, Cindy. If it doesn't, do a little reading. We got plenty of information at moneytalksnews.com. Just do a search for bonds. You'll be reading till the cows come home. Okay, guys, let's finish with our quote of the day. This comes from Frank Clark. He's an author. And he says, the more you learn, the more you earn. And that's appropriate advice for Cindy there. Learn a little bit about bonds. Okay, guys, have a super profitable day and meet me right here next time.